If someone's income is low enough that they have additional wiggle room to pull more monies from an IRA qualified account without paying tax on it, if they don't need the money, right? If they need it, put it in the savings, it's tax-free. Because their standard deduction and their Social Security's not taxed, so they got enough wiggle room where they could bump their income and pay no tax. So if they don't need the money, then the second option will be we'll get the money from the IRA into the Roth conversion.
Welcome to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Anchored in family values, Wayne offers practical advice to help you get the most out of your retirement years. For more information, visit today'sretirees.com. Now, here's your host.
And welcome to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. There's a song that is ringing through my head, and we normally sing it at Christmas time, Wayne. It's the most wonderful time of the year.
No, tax time.
Tax time.
Mm-hmm. For some it is.
All of the people that do taxes, they love this time of year because their coffers are being piled up really well.
But they're not getting much sleep.
No, they're not. I know some folks who do this kind of work, and they're working crazy hours.
Yeah. No thanks.
And all of the, the last 2 years with the COVID and stuff, it's just been nuts. People's incomes have been weird, and, so it probably makes their job a whole lot more difficult.
Yeah, and there's some fraud out there, like unemployment fraud and stuff with people's, Social Security numbers got taken. They're getting unemployment statements, say, hey, we were never on unemployment, and some other stuff going on too, But
so somebody's drawing unemployment on their Social Security.
Or they did,
wow.
And their identity,
Wow.
Yeah, a lot of that went on.
So tax time, it's kind of too late to plan for this year, isn't it?
Pretty much, yep.
I mean, for the 2021 year. Mm-hmm. Is it a good time to start planning for the 2022 year? Or are we still behind the curve?
So you got to get your tax return back. And so that's what we're going to talk about in today's show is, what to look for once your taxes are complete. Mm-hmm. And so many people miss kind of a key area of tax planning that's so easy to do, and it's just overlooked. Their accountants don't get proactive with them, and don't tell them, hey, look at this, what you could do, this, and it's such a simple thing. And let me give you an example. One of the areas is some people don't have, I shouldn't say extravagant, but they live a pretty simple life. Mm-hmm. Okay? They don't spend a lot of money. Their income is low. They have money in like IRAs, retirement accounts sitting there from over the years, but they're not drawing on them.
Okay.
Because they don't need it. Their Social Security and whatever other income they have sustains their lifestyle.
Sure.
So they got all this money sitting in their IRAs or 401ks, 403bs, 457s, right, deferred comp. And it's just sitting there, and they don't want to take it out because they don't need it. Mm-hmm. So it just grows. But their income is so low with the tax code now and the high standard deduction and the fact that, many people don't pay tax on their Social Security or very little, that there's wiggle room between the income they're taking and the income they can take and still pay no tax.
Oh, really?
And this window could be, $5,000, $10,000, $15,000 that they could have had more income and still paid no tax.
Okay.
So that's one thing you got to keep an eye on. If you paid no tax for the year, and you look at your return and you're like, geez, I paid no tax. I wonder how much more I could have pulled from my IRAs and still paid no tax.
Okay, sure, I get you. All right.
And if there's room there, why aren't they doing it? Why aren't they pulling from the IRAs? The second part of this is if they don't need the money. Well, we're not going to pull it because we just don't need it. What are we going to do with it? We'll take it out of our investment and stick it in a bank paying nothing, right? But there's another thing you can do. You can do a Roth conversion with that amount. Say you could pull another $10,000 and still pay no tax. Why not convert that IRA to a Roth IRA? And then that grows tax-free forever, your life, right? And that's an amount of money that you won't have to pull required minimum distributions on when you're 72 years old.
Okay.
So it's kind of a double benefit. If you're not going to pay the tax anyway, why don't you get it into an account that will never be taxed again?
Wow,
right?
You're right.
So, and some of these people, the window of opportunity to do that is only until they reach the age 72, because then the government starts making you take your money out of, and then that may fill in that gap of that untaxed money.
Okay.
Okay.
So you only have a short, well, I say short window, a window up until 72 when the minimum distribution kicks in.
No, I said that can be a window for some
I
people.
see. Okay.
Some people that even get their minimum distribution still have wiggle room to pull additional monies out and not be taxed on it.
Sure.
So those can be converted to Roth too if you don't need them to live on.
Sure.
I mean, it happens to more people than you think, and there's just an opportunity being missed.
So that when you get that return back from your accountant or whoever's doing that, that's critical to take a look at that, like you say, and could I have drawn X more?
Yeah, and we do discounted tax service for our clients, $90, right? Full.
That's a good
full
deal.
Blown. It's a good deal, not only just for the tax prep, but because our CPA is proactive, and along with myself, we look at that stuff. So not only do you get inexpensive tax prep, very well done by a very sharp CPA, but you also get some proactive planning like this, so you don't miss that opportunity.
Sure.
I mean, just think, if you had $10,000 and you're normally in a 10 or 12% bracket, and you convert that to a Roth, that's $12,000. I mean, $1,200. That's the tax you'd pay if you converted it to a Roth.
Okay.
If we can get that 10 converted at no tax because you have that wiggle room, you're saving $1,200 by getting that into a tax-free Roth.
And then that grows tax-free.
And that grows tax-free. So not only are you getting the cheap $90, but you're getting additional professional advice on top of it. Wow. And in that example would be $1,200 in your pocket that your other CPA didn't catch. and you know how you can go back and amend returns for a few years. You can't, if you miss this opportunity, it's done. You can't go back and pull money out of an IRA or do a Roth conversion from 3 years ago or two. So if an accountant misses that planning opportunity, it's done. And pretty much that accountant cost you $1,200. Wow. Why wouldn't you convert that to a Roth if you have that wiggle room? Even $2,000, $5,000, $8,000, whatever the number is, it's free money.
Yeah, I mean that's what's in my head too. It's free money.
Free money.
And you don't have an opportunity to see free money very much in this lifetime.
Roths grow tax free forever. The only thing better than a Roth is an HSA, health savings account. Okay. That you get the deduction going in and it's not tax coming out. So, so the next best thing is your Roth. So getting money into a Roth at a 0% tax rate. Or I'll give you another example here after the break. Okay. Maybe you're willing to pay a little bit of tax. We'll talk about that.
All right. Well, friends, when we come back, we'll talk a little bit more about some of these tax saving tips that Wayne's going through. Go to Wayne's website, todaysretirees.com, todaysretirees.com, and we'll be back right after this.
We've all heard the word rollover when referring to an investment account at work or your 401k, your 403b, your 457 plan. What do you do with that when you've left your job and your 401k or other retirement plan is still at your old employer? Or what if you've retired? One thing you don't want to do is you don't want to leave your money, your retirement account, in your employer's 401k. Quite frankly, your old employer or current employer is the boss of your retirement account. So if you have questions about what to do with your rollover, you roll it to Wayne. Get it in your own hands where you have the whole universe of investments and choices, not just what your employer tells you can pick from. So contact my office for a free consultation on how to roll over your old retirement account.
And welcome back to today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. We're talking about that wonderful time of year again, tax time. And I know that all of us are just chomping at the bit, relishing to write those checks to the IRS. Some of us have to do that.
Yes, unfortunately.
Unfortunately. But you were talking as we took our break about we were talking about some tips, and in the last segment we were talking about Roth conversions and why you wouldn't you do that if you have the opportunity to save money?
I mean, this isn't a typical Roth conversion. This is just if someone's income is low enough that they have additional wiggle room to pull more monies from an IRA, a qualified account, without paying tax on it. If they don't need the money, right? If they need it, put it in the savings. It's tax-free, because their standard deduction and their Social Security is not taxed, so they got enough wiggle room where they can bump their income and pay no tax. So if they don't need the money, then the second option would be we'll get the money from the IRA into the Roth conversion. So the second step to that is if you're willing to pay some tax, the lowest tax rate's 12.
Okay.
Right? But, the first, say, 10 grand of your income isn't taxed at all. It's a zero tax rate, right? And then it's stepped up in.
Sure.
So some people, even though they fall into a 12% bracket, their effective rate is much less.
Sure.
Maybe 6 or 7%. So you can play around with the accountant and look at the numbers and see, hey, what if we convert 10 grand into a Roth IRA this year? How's that going to affect my taxes for next year?
Okay.
And you could end up, getting money into Roths, and this works best for people under 72 before their RMDs start. Because once that forced money is you can't do anything. You got to take it out.
Sure.
But if you can get some into a Roth IRA that would normally have that minimum distribution at 72, if you can get some into a Roth before then at a lower tax rate, you're saving your future money.
Okay.
And then that money in the Roth grows tax-free. So that's just one way to do Roth planning for retirees that have lower incomes and modest lifestyle.
Sure.
And the lower income may not be that low, right? With if their Social Security isn't taxed, and then their extra income, falls with the standard deduction,
sure,
of $28,000,
Right.
for a retired couple over 65. That's a big standard deduction.
Sure.
It's a lot of income wiggle room.
Right.
So that's what you got to keep in mind with a proactive accountant.
But that's what I was going to say. You need a good financial planner with a good accountant.
Or a financial planner that could read a tax return that says, hey, you didn't pay any tax last year, and it looks like you have some more room to pull out more money or do Roth conversions. Yeah.
And then make those suggestions like you're saying, we could do this and do this. And
yeah, and then if we're not the ones doing their taxes, some people have a good relationship with their accountant and they're not going to move. So, we would say, hey, can you ask your accountant, I see here you might be able to pull more money out and either put it in the bank or do a Roth conversion from your IRAs. Could you have your accountant run some numbers?
Sure.
And have your accountant give you the number.
Okay.
How much can we pull out without paying tax? Or how much can we convert to a Roth without paying tax? And if they come back with a number, tell them, why the heck didn't you tell me that last year or the year before? And seriously, you should tell them that.
Right. Say, come on, guys, you're
Right.
killing me here, as the old saying goes.
Exactly.
Right? Yeah. Well, let's talk a little bit about the refund. A lot of folks, I shouldn't say a lot. Some folks, especially if they're working, they probably get a refund. If they're still working.
It depends.
It depends.
Yeah, it depends.
But
even if they're still working, some have to pay in.
The federal government is not a good bank, is it?
No, they don't pay a lot of interest.
Right. The banks don't pay any interest today either. So.
Yeah, but Rich, some people like a refund because if the money was just in their checking account, right? Say they got paid more in their check from their work, it would just get spent.
Okay.
So some people use it as a forced savings, and they have the thing spent already before they even do their taxes. Oh, we're going to do a deck with this, or we're going to buy new furniture with that. So,
Okay.
Your bank account doesn't pay interest either, right? So,
Right, yeah.
some people enjoy the refund. I'm not saying that's the right way to do it. It's just they know they're getting a check in April and they like that.
You're right.
So it's just different. Other people, they'd rather not see the IRS hang on to any of their money, and they don't mind writing a check at tax time.
Sure, right. So that's mainly like we talked about in earlier programs, kind of the personality of the person and how they feel about whether or not they want to just write a check to the IRS.
Yeah, or what they're used to.
Right.
Over the years they get in their habits. It's just everyone's different. But
there's not a good or bad into that. I mean, in your opinion, or in what you advise folks?
It depends on the situation. I mean, if they're getting a big refund, say $6,000, right, and they're in the habit of just spending that and not saving it, it's like, and maybe they shouldn't be. They lived without the $6,000 all year. Maybe they should consider putting it into an IRA,
Sure,
or a Roth IRA,
right.
And not spend it. Depending on their situation. They lived without it, so why spend it? Some they talked about spending it. We're getting the refund, so they spend it maybe more frivolously than they would write a check out of their checking account for. It's everyone's different. But.
Sure. I mean, I know a guy that is a car dealer. That's the word I'm looking for. And he actually says this time of year, when folks are getting their income tax checks back, they that's when they come and buy. Not they buy all year, but this is a big time, for.
It's a down payment on a car.
Right. For some. So hey, we're going to take a quick break. When we come back, we're still talking about taxes, and we're going to talk a little bit about the withholding and these kinds of things. Kind of goes along with what we've been talking about. But we'll take a quick break. Why don't you go to Wayne's website? On his website, you can sign up for his newsletter. It's absolutely free. They'll send it to you. On his website, you can click on his YouTube channel. You can look at all of these programs that we've done over the last several years, and you can look at different topics and all of that kind of thing. But you can get there through todaysretirees.com. It's todaysretirees.com, where you can also pick up the phone at 866-626-3990, make an appointment, and go in and sit down and let Wayne help you put together a good plan for your life. We'll be back right after this.
A certified financial planner is a true professional, a well-rounded, holistic planner that helps you in all areas of your financial life. Estate planning, tax planning, financial planning, insurance planning. We have to sit for a 10-hour, 2-day exam, at least back when I took the test. It's not just a weekend designation where you go somewhere for a couple days, pay a couple $100, and now you have letters behind your name. One thing I think is important is that you try and find a independent certified financial planner. Somebody that doesn't work for a big firm. I myself own my company, Great Lakes Benefits and Wealth Management. The buck stops with me, an independent, certified financial planner, one of the only ones on the north coast of Ohio.
Welcome back to today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. We're talking about taxes today, and if you missed some of the earlier segments, you may want to go to Wayne's website at todaysretirees.com, and you can go to his YouTube channel and watch that. Talked a little bit about some Roth conversion ideas that Wayne has, and refunds and all of that. But in this segment, we want to start off talking about Roth contributions versus IRA contributions. Now, in my brain, I'm thinking, why would anybody want to do an IRA if they can do a Roth? Only because I've listened to Wayne for several years, and the Roth grows tax-free,
Yes,
correct?
correct.
So if I'm going to invest money in a retirement account, the Roth always makes sense.
Well, that depends again too.
I knew he was going to say that.
Yeah, I mean, if everyone would do Roths, if everyone thought like that, and the problem with the Roths is you're going to feel the pain today.
Okay.
I'll give you an example. So if you are in a 22% bracket, okay, so if you're a married couple and your income's over roughly $75,000, you're in a 22% bracket.
Okay.
If you put $10,000 in a traditional IRA, say 5 for the wife, 5 for the husband, right? Say 10 grand. You can put up to 14 in, but just round numbers. And you're in a 22% bracket. You put the 10 grand in an IRA, you're going to save $2,200 this year.
On your taxes.
On your taxes.
Okay.
So if you owe Uncle Sam $6,000, now you only owe him $3,800. Okay.
Okay.
If you put the same 10 grand in a Roth, you're going to owe Uncle Sam $6,000. So would you rather owe Uncle Sam $6,000 or $3,800 today? If you're writing a check right now,
Sure.
the $3,800 seems a lot better, and that's how most people think. But if you put the money in a traditional IRA, you save the $2,200, and then you let it set for 20 years, right? Let's just say 12 years, just for simple math. So simple math, if you average 7% on that IRA, you're going to double it in 10 years. So you'll have 20,000.
Okay.
Okay. If you let it set another 10 years, you'll have 40,000. So let's do the 20 years. So you have 40,000. Now you want to use the IRA money. Well, you're going to owe tax on the 40,000.
Aha. Right.
Right? You got the tax deduction when you put it in when it was 10. It grew over 20 years to 40. Now as you use that money, you're paying tax on the whole 40. If we would have put that in the Roth, we'd have had to pay $2,200 more in taxes, right? Because we didn't get the tax deduction. But now that $10,000 grows to 40, and we have a $40,000 hunk of money that's tax-free. Right. So that makes the most sense.
Right.
Providing you can write the check now with a good heart.
Okay.
Some people just say, you know what, I really don't care what's going to happen 20 years from now. I'll take the $2,000 deduction today. Or 22. So, and some people argue, well, yeah, we're in a 22% bracket now, but when we retire, our income will be lower, right? Which may be the case, especially for professionals that are even in the higher bracket, or business owners, people that make, $200,000-300,000 grand or more. So yeah, you may be in a lower bracket when you retire. So maybe you take the tax deduction now in a 401k or SEP or IRA or whatever and forget about the Roths. But one thing you want to keep in mind is we don't know what tax rates are going to be 40 years from now. We don't know what they're going to be in 5 years.
Right.
So we know what they are today. Some people feel let's get the taxes paid today. And they're historically low, by the way, our tax brackets right now.
Sure.
So why not do the Roth, get the taxes paid, and be done with that money for the rest of our lives?
Sure. Now, which brings me to, for the rest of our lives. Now, didn't they change the rules recently after you pass and you give that Roth to a child or whatever? Don't they have to draw so much?
Yeah, but that's kind of a different show.
Right.
We don't care about them on this show today.
Okay.
We don't care about the kids.
Yeah, let those guys.
But yeah, for IRAs and Roths, if you an inherited Roth to a non-spouse, they have to empty the account in 10 years.
Okay.
Versus they used to take the rest of their lives.
Sure. Okay.
So as far as the Roth now, it's you want to look at the investor's lifeline, and then we could bring other factors in it for planning, like, hey, we want to hook our kids up with tax-free Roths, so we'll take the pain today, we'll pay the extra tax, so we have it tax-free, and then our kids get it tax-free too.
Sure, right. But that all sets down when I say that all happens when they sit down with you and discuss all of this and figure out what makes sense.
Yeah, I mean, it's part of the planning process.
Because I can see what you're saying. It depends. I mean, this is his answer. Each situation is different.
Mm-hmm.
Each family is different. You know, like you say, I might pay the $2,000 or $2,200 up front versus, you know, a little bit less, you know, and all of those factors, you got to figure all that out.
Yeah, and some people do both. They'll put some money in a Roth and some money in a traditional.
Sure.
Split the difference. You know, it's not all or one. The same goes, by the way, for retirement plans at your employer. Because most of I shouldn't say most, a lot of the employers now offer a Roth 401k
Okay.
along with a traditional 401k.
Okay.
Now, the benefit of those are you can put more money in. It's not just the $7,000. Now you put $20,000, and you know, if you're over 50, you put $26,000 away. You know, but now the tax burden is even more. If you're in a 22% bracket, if I do a $20,000 contribution to a traditional 401k at 22% tax, I'm going to save $4,400. If I put that same amount in the Roth 401k, I'm going to have to pay $4,400 more in taxes. So that's, you know, that's the pain. But mathematically, it usually makes sense to do the Roth, take the hit now, have our tax-free pile of money in retirement.
Sure. And that, friend, this is what Wayne does. This is how he helps you put together a plan. He helps you, not only does he help you make that plan, he helps you work through that plan. Because he'll step with you and his team will step with you as you different areas of your life. You know, I'm at that age now where I'm thinking about things that I didn't think about 25 years ago. You know, I mean,
For sure.
So, and you know, he helps you walk through those various stages. You know, it's kind of like having your family doctor. You know, he may not work on your heart, but he helps you walk through all of those parts.
Yeah, I mean, you need someone to help you put it all together. You know, there's agents, there's brokers, you know, there's people that say they're financial advisors that just sell stuff. I mean, you want preferably a certified financial planner that has a fiduciary responsibility to help you do what's in your best interest. And when you find somebody like that, they'll walk you through all these steps.
Well, it's very important. Friends, take the time to go to Wayne's website. We're out of time at todaysretirees.com. We'll see you the next time.
Thanks for tuning in to Today's Retirees with certified financial planner Wayne Maslyk of Great Lakes Benefits and Wealth Management. Visit todaysretirees.com or call 866-626-3990 to schedule a no-cost appointment with Wayne. Today's Retirees is brought to you by Great Lakes Benefits and Wealth Management, family-focused retirement and tax planning services, anchored in family values. Information and opinions discussed on Today's Retirees do not necessarily reflect the opinions of this station. Opinions expressed should not be substituted for individualized consultation with a qualified financial advisor. For specific information, call 866-626-3990 or visit todaysretirees.com.